Welcome back to the Global Ledger. I'm Justin. One of the most frustrating experiences in markets is watching prices move in ways that seem completely disconnected from reality. Earnings don't change, cash flows don't change, balance sheets don't change, and yet prices surge or collapse. At some point, every serious observer asks the same question: why do markets ignore fundamentals? And just as importantly, why do fundamentals suddenly matter all at once, often violently, too? That's what today's episode is all about on the Global Ledger. So, let's get into it. So, what do we mean by fundamentals? Let's be precise. When we say fundamentals, we usually mean cash flows, earnings, balance sheet strength, long-term economic value. These are slow-moving variables. They evolve over quarters and years, not minutes or days. Markets, on the other hand, trade continuously. This mismatch in time horizons is the first clue. So, it's tempting to think that markets exist to price fundamentals, okay? But they don't. Markets exist to clear trades. Every moment, markets answer a very narrow question. At what price will the transaction settle right now? That price reflects who needs to transact, who can provide liquidity, what balance sheets can absorb risk, and what funding is available. Fundamentals are only one input, and often not the dominant one. So, most of the time, markets are driven by liquidity conditions, funding availability, positioning, risk constraints, and balance sheet capacity. When liquidity is abundant, risk is cheap, okay? Spreads compress. Fundamentals don't disappear, they just get overridden. This is not irrational behavior whatsoever, okay? It's mechanical behavior. And why does this feel like a bubble? Though, when prices drift far from fundamentals, we often call it a bubble. But bubbles are not created by collective delusion. They are created by easy funding, low volatility, stable collateral, and balance sheets willing to expand. As long as funding holds, markets can stay detached from fundamentals for a very long time. This is why being right too early feels exactly like being wrong. So when do fundamentals matter? Fundamentals matter when funding stops smoothing reality. Okay, this happens when leverage reaches its limits, liquidity tightens, margins rise, balance sheets retrench, or forced selling begins. At that point, markets are no longer forward-looking. They become constraint-driven. Prices snap back, okay, not gradually, but suddenly. And this transition is violent. And here's why. The transition from liquidity-driven to fundamental-driven markets is abrupt because positions are crowded, balance sheets are full, risk limits are binding, and time disappears. When funding breaks, markets must reprice immediately to levels that clear without leverage. That repricing often overshoots fundamentals in the opposite direction. The same forces that inflated prices now compress them. Okay? This is not a behavioral story, okay? It's important to be clear. This is not about greed and fear. It's about funding constraints, margin mechanics, and balance sheet math. Behavior follows structure. So when liquidity is plentiful, risk-taking, it looks rational. When liquidity vanishes, risk aversion looks rational. Same people, different constraints. So, this is an important episode, and here's how it fits with the unified ledger we were talking about. From episode 91 onward, we've been building a unified view of the system. Here's how fundamentals fit into that ledger. Okay, fundamentals anchor long-term value. Liquidity determines short-term prices. And funding decides when fundamentals matter. Okay, funding decides when fundamentals matter. Markets oscillate between these regimes. Understanding which regime you're in really is everything. So for policymakers, misreading liquidity-driven markets as fundamental strength leads to complacency. And misreading liquidity stress as fundamental collapse leads to overreaction. For investors, fighting liquidity with fundamentals is dangerous. Ignoring fundamentals indefinitely is worse. The skill is not prediction. It's regime recognition. Now that we've seen how liquidity can dominate fundamentals and how fundamentals reassert themselves, there's a bigger implication. If liquidity governs expansions and contractions, then maybe what we call the business cycle isn't really about production or demand at all. In the next episode, episode 95, we're going to reframe the entire concept, the business cycle as a funding cycle. Because once you see cycles through funding instead of GDP, the economy starts to make a lot more sense. That's next. Thank you for listening to episode 94 of The Global Ledger. We talked about liquidity-driven markets in fundamentals and how this fits into the unified ledger. So once again, I'm Justin, and thank you for being here.